Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Marissa Ansell, head of ETF Investment Strategy at Goldman Sachs Asset Management, Ed Lopez, managing director and head of product management at VanEck, Ryan Kirlin, president of Alpha Architect, and Steve Wreford, portfolio manager of global thematic equities at Lazard. We're here to discuss navigating short-term market volatility and identifying where the long-term opportunities and themes are. It is great to have all of you with us. Welcome to Trade Talks. Marissa, we'll kick it off with you and go around the table here. Certainly the composure of the market has shifted from what perhaps expectations might have been in the beginning of the year, and now we're navigating what's somewhat of an uncertain environment.
Yeah, we are, absolutely. And actually the number one question we're getting from clients right now is, how should I be positioned in this market environment? It's volatile, there's a lot of uncertainty still. Our advice to clients is control what you can. And I think one of the things that clients can control is making sure that their portfolios are well balanced, well diversified. We're always an advocate for making sure that portfolios are well balanced and diversified, but I think that's even more important now when there's so much uncertainty. I think diversification is an antidote to volatility and uncertainty in many respects. And we would encourage clients as they think about diversifying their portfolios, don't miss opportunities outside of the US. And I think India, as an example, is really a hidden gem. It's a very, it's a large, very fast-growing economy. It's got a very deep, very diverse, very interesting equity market, and it's actually a great diversifier for client portfolios.
Yeah, and Ed, when you think about it from a thematic perspective, you can leverage the short-term volatility in a space such as the semiconductors.
Yeah, no, absolutely. Semiconductors have been on a tear over the last few years, and what we saw with the Trump terrorizing the market was an opportunity to get back in and step back into to some of those names that might have been overvalued. But I think we're going to hear the word diversification a lot today, because I think that is important, and we think that's important even in thematics as well. Semiconductors is great for that. Particularly, that industry is so diverse, even just within that theme or within that sector. There's a lot of different ways of tackling it, and you don't want to just bet on any one name.
Yeah, and when you're thinking about the short-term volatility and where the longer-term opportunities present themselves, there has been a generation of investors who perhaps have not traded or invested through a longer-term volatile environment.
Yeah, I was just thinking about that the other day. If you, maybe I'll tell my age. I graduated college in 2009, so stock market's pretty much just been straight up. So it makes it a lot easier to deal with. You do have these pullbacks, and the one market structure thing I'm a believer that has changed is information travels faster than ever. We used to communicate via smoke signals, right? And now, that's a stolen line from Warren Buffett. It's changed, right? Even in 2008, you didn't know things instantly. Now you do via the power of the internet. And I think you see that, and people are still surprised by it, I would say, but I think you should get used to it, right? March 2020, oh man, the world's ending, and it might have ended. But then once the coast was clear, the market came back faster than ever because everybody knew the coast was clear, right? And then we see this again with the tariffs. Oh man, tariffs are coming. This is going to blow up the entire economy. Word came out that tariffs were getting smoothed out, and maybe we didn't think it was bad. So what happened? Market snapped right back, right? And that's because everybody knew. Everybody knows the info fast now.
Yeah.
So that's a difference.
Which is interesting because this also lends to opportunities when you think about megatrends as well, Steve.
Absolutely. So yeah, we have a long history in this area, 20 years at Lazard, and our strategies go back to 1986. So as Ryan says, we've seen a lot of volatility during that time. And during those moments of volatility, the number one lesson we've learned is there is no better time to focus on the long term, because those long-term structural opportunities, those generational opportunities are available to you at a discount. And when everybody else is focused on the near term, that's the moment when you need to be thinking about what's coming next and tap into the biggest megatrends of the next decade.
What are some of the megatrends that you've identified?
So, well, I mean, in our recently launched Lazard Equity Megatrends ETF, we have 6 themes, and I think the sort of areas that we're looking at, of course, will include some technology, and I'll leave Ed some room to talk a little bit about that space. But I would highlight maybe 3. There's the application of AI is super important. We're starting to see some great examples of that I'd point to a company like RELX out of Europe, which is tapping into that AI opportunity in the legal space. And if you can imagine, if you're a law firm and you're not using AI over the next 5 years, then you're going to find yourself as the equivalent of the last horse on the FDR, I would suggest. So you'll be left behind by everybody else. Other hot areas, of course, healthcare is always a hot area, so lots of interesting long-term opportunities there at a moment where policy is introducing some uncertainty into the market. And then finally, one of the things that we're hearing repeatedly from companies is that they're intending to make larger CapEx allocations, so they're going to spend more on areas like automation. So there's lots of interesting opportunities out there available, at a moment of uncertainty.
Which is interesting, Ed, because that follows on with your thesis here that semiconductors are the foundation of the AI megatrend.
Well, yeah, semiconductors are the brains behind technology today, generally, definitely behind AI. And we believe that there's just a long-term trend still in place for AI and AI adoption. The big hyperscalers are still spending a lot on CapEx and AI infrastructure. I mean, they're chasing AI like it's the last biscuit at Sunday dinner. They're going after it, and there's still a long runway there, and that's being supported by trends like advanced computing, being supported by trends by the mere fact that AI and technology and semiconductors have become a strategic asset for many nations. So there are incentives by countries around the globe to help support local manufacturing and dominance in the technology space and the semiconductor space. But then semiconductors themselves, I believe, are not all the same thing. It's not all, cars, it's not all like a bunch of companies developing the same kind of car with 4 wheels and a steering wheel. It's companies that are dominant in certain areas of the market, whether it's AI chips, whether it's the equipment that help build those AI chips, whether it's the connectivity components that help make those AI chips quicker. There's ways of playing the AI market through a diversified portfolio that's not just NVIDIA. That's been the big name over the last few years, but it's the brains behind that technology.
Which is interesting because we're going to get into active versus passive management and the approach, as you're looking to identify these trends under more of a microscope. But I want to go back to you for a moment, Marissa. You've identified India as a region, right? And leveraging the short-term volatility there. Why is this a hidden gem? Get into your thesis some more.
Sure, yeah, happy to. I think India has, a pretty unique and actually very powerful combination of 3 things. 1, scale, 2, growth, and 3, diversification benefits. So let's talk about scale for a second. India has the largest population in the world. It's actually overtaken China at this point. It's also got the 5th largest economy in the world. It's got the 4th largest equity market in the world. More than 5,000 listed companies, about $5 trillion of market cap. So there's plenty to invest in. So it really has a lot of scale. Number 2, growth. India is growing very, very fast. It's actually set to overtake Germany and Japan in the next 3 years and become the world's 3rd largest economy behind just the US and China. And as investors, what actually matters more to us than necessary GDP growth is actually corporate earnings growth. But in India, corporate earnings growth is very closely correlated with GDP growth. And so over the next couple of years, we expect earnings growth to be around 12–13%. And so put all that together, you've got a very large economy that's growing very, very fast. Now let's talk about the equity market. And this is where I think it actually gets very interesting for equity investors, particularly here domestically in the US. Because India as an equity market is actually very lowly correlated with other equity markets, both on the developed side and also on the emerging market side. And if we take correlations between India and the US as an example, over time, they've actually hovered around 0.5. So very, very lowly correlated. So I think it's a really interesting example because it allows you to get exposure to a very fast-growing market. You've got great companies, that are growing, that have strong fundamentals, growing really fast, but they also add not just return potential to your portfolio, but they can actually also add diversification benefits.
Yeah, they certainly can. And let's put geography and the investment themes together here. And think about the impact of geopolitics on the markets in general and how you're thinking about that from a longer term perspective.
Yeah, I mean, we're on the equity side, we're generally quantitative, factor-based investing. So, we don't too much take a view. We do momentum and we do value investing. So we just kind of look around, is India going up? If so, good. Maybe we'll get in it. That would be momentum. And then on the value side, is India getting really cheap because everybody's scared? Then maybe we would get in it, right? As some simplified examples. So we don't really take macro views. Macro, I think, is like just a really, really hard game to get right. There's probably 4,000 macro variables out there. And then what I always say is all those macro variables matter, but then at times there will be one macro variable that rules them all, and now all that analysis that you did doesn't matter anymore. Again, going back to like the pandemic, we could have looked at inflation and we could have looked at oil prices and this and that, but then the only thing that mattered was there was a global pandemic and stocks were going down 40%.
Right. Well, I mean, the market's always going to climb some wall of worry, right? So when you think about diversifying your portfolio, whether it's fast drawdowns or slow-moving markets, there's always going to be a market for that.
That's right. Yeah. I mean, and we like for fast drawdowns, we think, if you told me tomorrow the market was going to go down 50%, well, the best thing to own would be 50% out of the money put options on the S&P 500, right? And that's how we use our chaos ETF, because it owns put options.
Inserting chaos into your portfolio?
Yeah, insert some chaos into your portfolio. We were joking about that before the show. Yes, put options are a good idea. That's what we use our chaos ETF for. It owns put options. If things go down fast and they get scary fast, own put options.
Yeah, so let's talk about this more holistically, Steve, when you think about the benefits of an active ETF versus a passive approach. This market seems to be a perfect example of why active management is becoming more popular.
I think that's right. I think there are sort of two underpinnings here. The first is that there's just more interest in thematic investing in general. If you look across, it's a demographic issue. Only about 9% of the baby boomer generation invests in thematic strategies. That number jumps to over 40% of Gen Z or millennials. So that's a very important aspect, I think, for all of us here. And then when we think about an actively managed ETF, such as Megatrends, and kudos to our own ETF department, by the way, who secured the ticker THMZ. We were just talking about that beforehand, and so that's great. But themes, when we look at themes, the active approach means that you're able to look forward all the time, rather than just looking at what's in the news today. By the time something hits your social media today, it's probably already in the price. I'd suggest that our approach of talking to companies, see what they're doing, where are they investing on a 5 to 10 year view, and then implementing themes bottom up seems to be a very interesting approach to us. So when I think about the big themes that every investor has to really build into their framework today, it absolutely includes things like AI, the shifting geopolitical landscape, and societal and behavioral changes as well. So a holistic approach, actively managed, is the best way to be able to do that.
I think your comment on demographics is really interesting. I feel younger demographics understand the benefits of ETFs and recognize that, okay, we can't replicate a portfolio manager's book. It's not efficient, doesn't make sense for taxes, it's too expensive. And rather than having to pick that one stock, in NVIDIA as an example, they're able to leverage a product such as an ETF to remove some of that correlation risk, remove some of the concentration risk, and have exposure.
Yeah, absolutely. I think active management is important in markets like this, and I think certain investors can be active with even passive ETFs. And certain thematic ETFs like our semiconductor ETF SMH and our new fabulous semiconductor ETF SMHX allow investors a way to get exposure to that theme, to perhaps trade around it if they need to, though we believe that semiconductors now should be kind of a core holding. They're kind of a long-term play and a strategic focus for nations, as I mentioned. But yes, I think there's an opportunity for people to use ETFs to get a diversified portfolio instead of just betting on a single stock.
Yeah, and even if you look at it from the regional perspective, we'll go back to India again, you need to have that local expertise as well. To your point, understanding how the equity markets trade in response to what's happening with the macro.
Yeah, 100%. So India is actually a relatively inefficient market, certainly compared to the US and to many other markets. And so I think you really need to go active. So I agree with the comments that have just been voiced in terms of the value of active management over time. But I think in India in particular, there are so many inefficiencies that exist, particularly as you go further down the market cap spectrum into that mid-cap space and the small cap space. And so I think you really want to go active. I think you really want to choose a manager that has a local investment team on the ground in the local market. They spend all day, every day looking at local companies and meeting with local companies. We've actually been managing India equity portfolios for more than 15 years at Goldman Sachs Asset Management. We've got an incredible team locally on the ground in Mumbai MSCI, and this is exactly what we're doing. And so we're really trying to go beyond the benchmark, invest beyond the benchmark.
Right.
And we recently launched GIND, which is the Goldman Sachs India Equity ETF. It's an actively managed portfolio. It's very, very nimble. We actually have about half the portfolio in small and mid-cap names. We invest in stocks that are not in the benchmark as well. We also seek to invest in IPOs. And all of these things, you can't do via a passive ETF or any kind of passive portfolio. And I think that's really, really important because, India, so little known fact, I think, that or many people wouldn't necessarily realize this, over the last 5 years, India is actually one of the few markets that has actually outperformed the S&P 500, number one. But not only does it have, great potential return potential, but I think it also has it's very alpha rich. So there's a lot of scope potentially to generate alpha on top of that if you can pick the right stocks.
Ed had made the point before that not all semiconductors are the same. So should investors consider making an allocation specific to India, or can they get that exposure through a global or emerging market equity ETF as an example?
I mean, I would say, any exposure to India is better than no exposure. Mm-hmm. But personally, I think that it does warrant a standalone allocation. And the reason I say that is because I think if you take India exposure via, let's say, a broad emerging market allocation or a global allocation, India is only 17% of the MSCI Emerging Markets Index. It's actually only 3% of the MSCI ACWI, the All-Country World Index. So your exposure is very, very small, considering the scale and the growth that I just talked about, number one. Number two, you're probably going to get exposure that's very focused on the large cap part of the market, and you're not really going to get exposure to all those small and mid cap names that we think are very rich alpha opportunities. And on top of that, I think, as I said, we really do want to look beyond the benchmark, and you want to look for sort of hidden gems, uncovered opportunities that local investors may know about, but other investors may miss.
Ryan, any other asset classes that investors should be paying attention to? I know you noted something around bond positions and thinking about treasuries as an example.
Yeah, I mean, other asset classes, man, that's actually a tough question. Yeah, I mean, it's kind of what Marissa talked about at the start. We just kind of view you want to have a diversified portfolio, own a little bit of everything.
Factor momentum kind of takes that emotion out of it, which really is the base case for quantitative strategies.
Yeah, I mean, for us, we have U.S. value, U.S. momentum, international value, international momentum, and it's going to hunt around the globe for whatever country or whatever stock you want to be in, and so that's kind of the approach we take. Yeah, we're not quite the macro on like trying to zero in on a specific country. I mean, one like high level thing I would say that we do believe in is, if you're going to own bonds, we believe you should own treasuries as like a simple solution for people instead of owning an aggregate bond index. And the simple reason on that why is, we don't have a treasury ETF. So, this is, I guess, I'm not the barber here. But we, if you look at the aggregate bond index in 2020, it was down about 7%. If you look at, I'll plug a competitor, if you look at SCHR, Schwab's Intermediate Treasury ETF, that was up about 7% in 2020, right? And in those moments of stress, man, you really want to own something that's going up versus something that's going down. So I would say own treasuries instead of...
it also goes back to the active management principle in general, and not just being locked into one specific theme.
Yeah, I think so. One of the things about thematic investing that we've found, and we try very hard to implement this in Lazard's megatrends, is there are hurdles. Picking the right theme can be challenging. Timing a theme in and out, nobody really tells you when to buy and sell, so it makes sense to outsource that perhaps. And then a final component of it is the implementation, the underlying stocks that you have. And the devil really is in the detail in this area. So these are all sort of hurdles, but nonetheless, I think the key point, which is actively managed strategies are able to face forward and say, okay, what's in the market price today? That's fine, but where is that thematic optionality? Where is the world going to be in 5 years' time? The market hasn't assigned any value to it today. It will in the future. And how do we position ourselves for that generational opportunity? And I think you can only do that through fundamental active management. And if I make one other point as well, which has already been mentioned here, not all of those opportunities are going to be in US listed securities as well. There are great opportunities in Europe about companies becoming more productive there. Some of those sort of manufacturing companies I talked about are based in Scandinavia or even Japan, where there's a great excellent sort of industry there as well. So we have to look further afield, consumer opportunities in India and beyond, and so on. Yeah. So it's great. I think actively managed, strategies face forward and enable you to capture where the world is going to be rather than where we've just been.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.